Our next panel, New to Market ETF Roundtable, will delve into these topics. Please.
Thank you, Steve. Super excited to be here. I love being one of the last panels of the day in front of such a standing room only audience such as this. But with that, I'd like to introduce myself. My name is Josh Jacobs. I'm the Chief Commercial Officer for the ETF business at US Bank Fund Services. Little thing about us is we actually are about 47% of the US ETF market we service today under custody and administration. And separately, we took in about 60 to 65% year to date of all new ETF issuers. So a lot of expertise in working with clients and helping to get to market. With that, I'd like to turn it over to my panel to introduce themselves.
Hi everyone, my name is Connor O'Neill. I work at Stonebridge Asset Management. We just launched our first ETFs this year.
Steve Feinauer. I'm a partner with the law firm Stradley Ronan based out of Philadelphia. Have a general investment management practice with a particular focus of ETFs for the past 18 years. I've been counseling ETF issuers on all aspects of the launch and ongoing operations of a variety of registered funds, including 40 Act ETFs, 33 Act only ETPs, including some of the spot crypto ETPs that launched earlier this year.
Good afternoon, everyone. Brett Eichenberger. I'm a partner with Cohen & Company, also lead our registered funds practice, where we specialize in auditing registered investment companies, including mutual funds, ETFs, and closed-end funds. Glad to be here today.
Awesome. So for this lively panel discussion, I brought an auditor, an attorney, and a first-time entry into the ETF space. So hopefully we can get some smiles out of the room and get you to drinks a little bit sooner rather than later. So kicking off the panel, I think I'll start with Steve. From a legal perspective, can you give an overview of what firms should think about when they're launching an ETF for the first time?
Yeah, sure, Josh. So part of it does depend where they're coming from. Are you an asset manager that has an existing 40 Act fund complex, maybe mutual funds, closed-end funds, or is this your first foray into the registered fund space? If you're coming from a 40 Act background and you have an existing fund complex, a lot of the 40 Act rules and regulations are going to look familiar. There's going to be, you're going to be filing an annual registration statement update each year. You're going to be doing shareholder reports. You're going to be having board meetings. But there are some ETF-specific nuances and some ETF-specific policies and procedures that you're going to have to develop when you're launching your ETF business, like Rule 6C11, which is the ETF exemptive rule under the 40 Act. And you're also going to be working with a number of new service providers and existing service providers that may be serving a different role or function than what you're used to with your other types of 40 Act funds. If you are, on the other hand, say you're a hedge fund manager and this is going to be your first entree into the registered fund world, it's called registered funds for a reason. It is a heavily regulated industry, highly prescriptive rules and requirements. And so some people, when they start learning about and finding out about all these different rules and requirements that it can be subject to, it can be a lot if you're not used to it.
Are there any paths that could speed the approval process? AKA, can you talk a little bit about the difference between a multiple series trust and a proprietary trust?
Sure. So that is a key threshold decision. Do you build it yourself, or do you utilize a turnkey or white label platform where you get to plug into their existing infrastructure? They already have a board. They already have fund officers. It's really an individualized decision, and it depends upon what your facts and circumstances are. If you're an asset manager who, you don't want to deal with all of that extra work and all that extra time and spending those resources to build everything yourself, and you just want to, you run your strategy, you want to just stick to running the money, and you want to kind of, rely on your key business partners to do everything else, the Series Trust white label platform may be the right path for you. It's going to be more cost effective. It's going to be a quicker path to market. On the other hand, especially, like I said, if you have an existing 40 Act fund complex, you may already have a lot of those things in place. So it may be not as heavy of a lift for an organization like that. Really, the point of sensitivity really is around. It's on the one hand the ease to get to market and cost efficiency to get to market versus the control. When you're using a white label or Series Trust platform, it's not your board, it's not your service providers, because you're plugging into that existing infrastructure. So if it's important to you to be able to make those sorts of decisions and constitute your board and pick the different service providers you're working with, then building it yourself may be the right path.
Yeah, no, and for those that don't know, that's a loaded question because at US Bank we offer multiple series trusts. In fact, we offer 10 different versions of it. But I think the key message that I want to get across and why I asked that question to Steve is ultimately that there's multiple ways to enter the ETF market. You can either build your own proprietary trust or have an existing infrastructure, which is a great method for many firms. It allows you to have full control and impact with the board, but you will need to hire a whole series of service providers, or you can go through an existing board structure and a multiple series trust structure, which to his point allows for speed to market and lowest cost entry to get to market because you're not having to take care of the fixed cost all on your own. It's diversified across multiple clients. So the reason why I bring it up at US Bank is we're the only place in the world, to my knowledge, that has custody, accounting, admin, TA, and a multiple series trust all under one roof. So for us, it's truly a one-stop shop. That being said, we're agnostic if you go proprietary trust or multiple series trust. It's really what's best for you and your firm.
I'll just add to that. One of the things that we have seen post 6C11 is a couple of things. One is mutual fund, traditional mutual fund trusts are launching ETF product within there. So that's a little bit of a nuance. But we also see clients have that decision of, do I want a specific board just for my ETF products, or do I want to use the same board as the mutual fund group? So that's something we continue to see in the marketplace, and clients are having that discussion about, should I have an ETF specific board? So another thing to think about is from a governance perspective.
Yeah, no, that's a great point, Brett, because there's lots of pros and cons to each. So for each firm, you really need to take a look at that and determine what's best for you based on your existing structure, what your cost outlay is, what you want to do upfront, and ultimately how you want to come to market. But from a speed to market, there's no beating a multiple series trust because it's an existing infrastructure, service providers, boards, and other entities. So it allows you to come to market relatively quickly compared to all other entrance points. Brett, so from there, when launching ETFs, are there any nuances from an accounting perspective that firms should be thinking about, and how does that compare to accounting from a mutual fund?
Sure. So there are some nuances with an ETF comparably to a mutual fund. So when you think about how shares are issued in a mutual fund, you're issuing individual shares directly out of the fund at net asset value. Pretty straightforward. With an ETF, we have creation units, large blocks of shares between 10,000 and 25 to 50,000 shares that are issued to authorized participants. So it's a new person or a new service provider in the ecosystem is a authorized participant, and they transact directly with the ETF at net asset value, and then those shares are then exchange traded. They're traded on an exchange, usually close to net asset value. There's a lot of things in place there to make sure of that, with a tight bid-ask spread, but that's a nuance when you think about from a financial statement presentation perspective. That's a different nuance. There's also two different total return calculations for an ETF. You have your net asset value total return, and you have your market value total return. So also kind of a nuance there. The other thing that I'll mention is what we see in the ETF land, and one of my partners talked about it this morning, is the in-kind creation redemption process. And this is also a difference in the ETF space. It's not to say that mutual funds can't do in-kind creations or redemptions or transactions, because they can. We've seen that in mutual fund products over the last 10 years. But primarily for an ETF, it's really the way that they transact. And what this does is under 852b6, these redemptions for property in kind are not taxable at the fund level. So that's a big difference, and that's how ETFs get managed, and that's how they get traded. So definitely some nuances there, and what really makes it attractive is the tax efficiency of the product comparatively to a mutual fund.
I love you name dropping unique items in the tax code. Really reminds me of your background. Told you I'm going to try and keep it lively because I see the looks in everyone's eyes, but okay. So you talked a little about the tax efficiency. I think there's some misinformation in the market about how that actually happens. Or do ETFs get rid of the capital gains in taxes, or is it really a deferral? Can you help provide some clarity to the audience and who may have questions on that?
Yeah, there's really two different basis levels. You have your fund basis level, which is what we're talking about here, which is at the fund level, these redemptions get paid out in kind. But the market value of the fund is the market value of the fund. You just aren't distributing capital gains on a regular basis. And that's not to say that ETFs don't distribute capital gains, because certain securities, as we know, within an ETF can't be transacted in kind. Certain derivatives can't be transacted in kind either. So you will have, net investment income, ordinary income distributions from ETFs, and some have capital gain distributions as well. But the outside shareholder, their basis doesn't change from any of this. So if they buy the shares at $10 and the NAV goes up to $20 and they sell those shares, that's their basis, and that's what they would pay a capital gain on.
Excellent. Now I'm going to turn to Connor, and I'm going to do a little plug for Connor's firm, because they've done something that not many have, which is they launched 32 products out of the gate, which is a tremendous volume and tremendous effort. So, Connor, can you walk us through how your firm decided to enter the ETF market?
Yeah, absolutely. And I have to say, listening to how simply these guys make this all sound is almost laughable, because it is much more complex than that, from actually putting it all into process and practice. Excuse me. Stoneridge has been around for 12 plus years. We have over a decade of experience with mutual funds. So a lot of what Steve was talking about in terms of having a trust set up, we were very familiar with. We had a lot of infrastructure set up to go that route. When we were exploring this product and how to best launch it, our default was to go to mutual funds, because it's what we knew, it's what we were thinking about, but we're always looking to innovate. And I think that in that process, we came across ETFs, and we figured that wrapper was actually a much better wrapper to produce the products that we wanted to get to market than a mutual fund. There's lower costs, it's easier access for investors, it's a little bit more popular, and we thought we had the infrastructure enough to build it all out. We learned quickly that they are quite different from mutual funds, but it was certainly the right route to take.
Couldn't agree more. There's definitely material differences, but that's where I think it was in an earlier panel someone mentioned your partner should be giving you consulting advice as you go through this. And so that's something we pride ourselves on, is walking you through that process. But that being said, Connor, as you went through this, what surprises came up as you went through your launch process?
Yeah, I think the first thing that we noticed was there were a lot of new players, a lot of new terms, a lot of new things to know. The day in the life was very different. Brett touched on some of it, coming from the standpoint of having a secondary market, having the in-kind creates and redeems. I think a lot of our knowledge, or a lot of our time spent in the beginning, was really trying to figure out what we didn't know. And that's where the bulk of our time was spent, especially in the beginning, and that's where US Bank and Josh's team really stepped up to help us out. They were essentially those consultants for us across the board. So not just the ETF ops team, but also how it impacted fund accounting, TA, all these things that we were very familiar with from the mutual fund side, learning that on the ETF side. So I think that was probably the biggest learning curve, and that's what we tried to figure out the most.
And I think it's. Oh, go ahead. I was going to say, I mean, that just really hammers in that point of, like, you mentioned relying on your business partners, like, engage early and often. I mean, that's what I always say. And that, we all fulfill our different roles in the ETF ecosystem, and we all have our own unique perspectives to bring to bear. And you get, by engaging early with your listing exchange, your US Bank, your auditor, your law firm, you get to leverage off of all of the prior experiences that we've had, but some good, some bad. And so that way you're not, getting caught up or having some of the footfalls that we've seen, a variety of asset managers, get tripped up on over the years as they bring ETFs to market.
Connor, I know when we talk to a lot of our mutual fund managers that are thinking about getting into the ETF space or converting into an ETF, one of the big differences is how it's traded, right? In a mutual fund, you have a portfolio manager that buys and sells the shares within the portfolio, whereas in an ETF, this in-kind process. I'm curious to how you guys made the determination to keep all of that in-house and not outsource some of those trading functions, and how you guys thought about that.
Yeah, absolutely. So I think a large part of it was that we had already built out a lot of the infrastructure. We felt very confident in our process and how we trade and what we manage from that front. I think the bigger part was once we learned how the in-kind create and redeems really work and how those shares can come in, we were able to put that into our process in a way where it really fit. So we get our basket of securities, they would come in, they would fit into the portfolio. We knew how to do rebalancing, or we learned how to do rebalancing. So we figured that out as well. And it actually fit the structure nicely for what we wanted to achieve. But it was definitely a learning curve. We had to figure out the APs and what they did exactly and how that flow worked. Having trades having shares transact on a secondary market and not actually come into the fund was very different for a mutual fund. We're used to somebody buys a share, we get money into the fund, and then we can deploy it. This is very, very different from that. So I think the learning curve was large, but once we got comfortable with it, it was able to fit into our ecosystem pretty well.
I mean, so thematically, what to think about here is engage your partners early because they've done this before. And your first time through the process, you heard from Connor, you don't know what questions you don't know. And so rely on your partners who've done this before to say, hey, have you thought about this? We've seen this trip up other clients when they're in this exact same stage of the process. And ultimately, by having those questions out front, it's going to be a different answer for every firm, but at least getting you thinking about them early allows you to address it so you're not scrambling around as you get closer to launch.
Josh, if I can just add to that too, I think it's also figuring out who the right people to talk to are. So as I mentioned, U.S. Bank was massive for us in that regard, but they were also introducing us to new folks such as the APs, the exchanges, and so on and so forth. Doing that early is incredibly important. The longer you wait for that, the harder it's going to be to get to market. So we started to engage in that on the early side, and that made a huge difference in our ability to get to market quickly.
I mean, I think that's even really important depending upon your strategy or your asset classes you're investing in. I mean, getting that sort of kind of feedback, from market makers and APs as to like how they're going to trade your basket, how they're going to trade the baskets and the portfolios is very important because, under 6C11, anything you can launch in a 40 Act mutual fund, you can do in an ETF. But there can be, a domestic equity, highly liquid portfolio is going to trade very differently than some of the more esoteric fixed income asset classes, for example. So,
not all asset classes are inkindable, and therefore there's different trading depending on what type of asset classes you have. So that's why every situation, unfortunately, is different. Connor, last question I had for you is, as you went through this process entering ETFs for the first time, how do you think about how to price your products as you're bringing them to market?
Yeah, so I think that it's unique per product, obviously, and we've talked a bunch about that. For us, it was very much based on the modeling that we wanted to do. The products that we launched are really bond products for retirement. So to price each one of our products was based on the longevity and the pooling that we put towards our model. So I think that a critical component there is trying to make sure you get it right from the start. I think that with mutual funds, we would often just launch them at $10 because that was kind of the standard price to launch at, and they move from there. For these, we had to put a lot more thought into that and really figure out the best way to go about it.
Yeah, it's not just NAV, it's also the management fee, it's also the basket size, it's also the basket constituents. There's a lot of things to think about that may not be consistent to the way you've done that business model in the past as a mutual fund manager. And so from our perspective, we're not going to tell you how to do it, but we're going to tell you the questions that you should be thinking about so that you can help make an informed decision as you go to launch your product. Because our view is, as a custodian administrator, if you gather assets and you have a greater chance of success, we all win, we all make money. So it's a good thing. Steve, one of the emerging trends with our industry is conversions. I know there was a panel earlier on 351s, but can you talk a little bit from both mutual funds and SMAs? What are the key considerations that people should be thinking about on what products would be appropriate as you look to launch?
Yep, sure. So mutual fund to ETF conversions is a relatively recent development. There's only been, it's been the last couple of years that the SEC started approving those. The benefit of that is that it enabled issuers to achieve scale and port over performance records. You have, an ETF issuer like Dimensional. They were some of the first, did some of the first conversions and were a top 10 ETF issuer overnight. That doesn't mean it's the right solution for everybody. I mean, I've had many conversations with clients who, once they took a hard look at and evaluated their intermediary and distribution network, a conversion ultimately ended up being not the right choice for them. It may be the case if you're heavily, your shareholder base is heavily retirement channels. Well, that's a segment of the market that the ETFs have not penetrated. And so it's not going to do you any good to convert a mutual fund to an ETF if you're going to lose a big chunk of assets in the process. There's also, considerations around the fractional, any fractional shareholder is going to get redeemed out as part of the conversion. Some of these you can do via without shareholder approval if it fits within certain rules that the SEC has put out. Sometimes you will need to get shareholder approval, but typically, all of them, you structure them so that it's a tax-free conversion from an investor experience standpoint, and so when they're coming, aside from the fractional shares, when the mutual fund investors are coming over to the ETF, then they're doing so on a tax-free basis. I guess the other point I would make, I mean, we've, all today on this panel, other panels, it's clear that the ETF wrapper has structural advantages from the tax efficiency and a lot of other things that people have talked today. That doesn't mean it's going to be a cure-all. If you have, a fund that has struggled from a performance standpoint, or you've struggled from a distribution standpoint, converting it to an ETF is not going to be a magic cure-all. There's plenty of examples of people who have done these conversions. They convert over an ETF, they get no volume, no assets, no inflows, and then they liquidate. So, those are some I guess key takeaways that I would advocate that people can take into consideration when they're thinking about whether it makes sense for them to explore or pursue a conversion.
I think the other thing to think about too is your portfolio composition. Not all mutual fund portfolios are good candidates for an ETF product. If a mutual fund can hold up to 15% of its assets in illiquid investments, generally you'd want to be talking to the market makers to see if they would want those names within the ETF product and would be able to make a market in those names. The other thing is to look at the portfolio as a whole too, and maybe there's some names in there that the market makers may say, hey, maybe we change these out, subtract these, add these, just to make it a little more efficient from a trading perspective. So those are some considerations too when you're thinking about the portfolios that you're converting over.
Yeah, I think ultimately it's a trend that we'll see continue. I think with the, we've heard about ETF share class and the possibility of the SEC granting that exemptive relief. I think that's taken a little bit of the wind out of the sails behind these conversions. I think there's some asset managers that are, maybe holding off and seeing what happens with the share class, that is a kind of an alternative path to a conversion. You can see how an ETF share class, assuming that gets approved, that can be appealing. All the things that I just talked about of potential disruption to your intermediary and distribution channels, losing your retirement investors. The ETF share class, although there's other things that go into it and other things to, from an operational and regulatory perspective to solve, to figure out and work through and solve, the benefit of that and the appeal of that is you get to keep your existing fund in place and all those different classes and all those different channels in place, and then bolt on an ETF share class. So it's less disruptive in a lot of respects.
Plus, go ahead.
Oh, we got four of us all trying to talk at once. We're going to go with Connor because he hasn't spoken a bit.
No, the only thing that I was going to add was that from a less technical standpoint and just in practicality, the other things to consider are just timing, right? Like the mechanics of how it actually occurs and what goes into it. They are different processes from seeding a new fund to converting and how that goes about. There's a lot to consider to actually fundamentally putting those things in place from a boots on the ground operational perspective.
Plus, collapsing share classes before conversion. We've seen from an operational standpoint, a lot of mutual funds pay their own expenses, whereas ETFs generally have a unitary fee structure, no 12b1 fees. There's a lot of those operational things to think about.
Yeah, definitely a lot of TA work as well. You basically, any of your investors who don't have an ETF eligible brokerage account, they need to set one up in order to receive these ETF shares that they're going to be receiving as part of the conversion. So it can be a lot of legwork in order to track down and get all the different investors to do what they need to do to be able to receive the ETF shares.
Well, now I'm going to plug myself because we are a full-service TA along with custody administration and accounting, so we can do it all under one roof. I don't know if you've heard that before, but I'm going to reiterate it for the audience and anyone taking notes. Go ahead, Connor.
I was actually going to say US Bank was incredibly helpful to us with that regard because we used US Bank TA for our mutual funds. And when thinking about conversions versus seeding and launching new funds, understanding the mechanics of can you have a direct account or not? How do you need to hold the shares of the ETF versus hold the shares of the mutual fund? Josh's team and the TA team did an incredible job of helping us understand that so we could actually be successful with what we did.
So if I could summarize, you're saying that it's better to have one provider than multiple.
Exactly.
Okay, just checking. Thanks. Back on the less of the shameless plugs. From a summary perspective, what you're hearing across is that not every vehicle is appropriate for an ETF. Not every product is meant for a conversion. But if you can find one that makes sense for you and your firm and for your investor base, you get that full benefit of being in an ETF with a more tax efficient, transparent, and increased liquidity. And so all those three things are compelling. And we'll talk about ETF share class in a little bit, and we'll see how that all plays out. But one thing you said, Steve, that I do want to discuss is conversions overall. So across our client base, what we're seeing is there still is a handful of mutual fund ETF conversions taking place. It's not as fast as it was, a little while back, but it's the opposite spectrum of what we're seeing from SMA conversions. So pretty much every client we're talking to right now who's looking into launching ETFs for the first time, if they have SMAs, is saying, hey, how do I get this in here? Does it make sense to convert this as seed capital? Is it a way that I can get credibility in the street by seeding with, we've had clients talk about almost $2 billion potential conversions. It hasn't happened yet because people are still looking at how best to do that from a SMA to ETF conversion. But we've had a huge volume of smaller ones that have taken place to date, and there's lots of nuances that go into that. But what I will say is everybody is talking about whether this makes sense for them, and that's the right conversation to have. Because if you can find a way to get more assets into a more tax efficient, more liquid, and more transparent vehicle, it's a win for the advisor and a win for the investor. Brett, how should an advisor think about third-party service provider selection, and what framework can you do to best nail that down?
I think I know where he's going with this.
No more shameless plugs.
Well, there's a lot of things to think about here. As Josh talked about, there are service providers that provide all of that under one roof, but there's service providers out there that maybe don't provide all of those services. So vetting those different providers and understanding from an apples to apples comparison, what am I getting here? Am I concerned with what's my biggest pain point? Is it custody? Is it global custody? Is it trading? Is it having access to SEC lending services? It's a case-by-case basis, and you need to understand the partners that you're going to be working with and vetting those out. And then when you're going and doing the due diligence in these proposals, just looking at it from an apples-to-apples comparison. What services am I receiving versus somebody else? The other thing we're seeing in the marketplace a lot now is, Steve touched on it a little bit, but it's if you're going to go a standalone product, do you want to have your own board? Do you want to be management? Do you want to be in charge of the financial reporting process? Do you want to be the treasurer, certifying the financial statements? Those are questions you have to ask from a business perspective. Am I willing to do all that, or do I want to outsource those services? Do I want to outsource those services to like a U.S. bank? Do I want to outsource those services to another turnkey solution? So there's a lot to unpack there, but really you should kind of whiteboard out what are the pros and cons of each of these, because we see a lot of fund groups that go alone in the beginning. And what's interesting we find is a number of them, if they don't have a large suite of products, they may ultimately end up in a series trust. And so we've seen that trend happen over the last 5 to 10 years of standalone groups going into the series trust model. But if you have a scale like Connor does with his group, it does probably make a lot of sense to have it all under in-house from that perspective.
Yeah, I'll just add, and I talked about this on another panel a while back if someone heard it, but there was a place that I was more wrong than I've ever been in my life when it comes to the ETF industry, and that was when 6C11 was passed, because 6C11 was unifying the standards, allowing for speed to market, not needing the exemptive relief in order to launch. And when that took place, the cost to launch an ETF complex and the time was going to go way down. So I thought, that's going to be the end of the white label industry. That's going to be the end of the multiple series trusts, which are different things, by the way. And I couldn't be more wrong. It's had the exact opposite effect, where those industries have flourished because now it's a lower cost, but you can take it even further by being part of a multiple series trust. So again, I thought that post 6C11 originally, a couple years back when it was passed, that would be the end of the multiple series trust and everyone would go down the proprietary trust model. And that's not the case. And if anything, it's had the opposite effect, and it spurred incredible growth in these multiple series trust models, as it allows you to get the even faster and even cheaper solution than that proprietary trust. But the proprietary trust does allow you to have more of that incremental control. And so there's lots of pros and cons on both. And again, back to the theme, you need to find out what's best for your firm, and we can help give you the pros and cons and walk you through that.
Yeah, I mean, you can look back over the last, so 6011 was adopted in 2019. 2020, we also had Rule 18F4, which is the derivatives rule. And so those two things in tandem really opened up the ETF wrapper to a whole host of new investments and strategies that previously it wasn't open to. It used to be under the pre-6011 exchange generic listing standards. There used to be all these quantitative criteria that applied to if you were an index ETF to the underlying index, or if you're an active ETF to the active ETF's portfolio, and it restricted, particularly when you went derivatives heavy or like the more esoteric types of asset classes, it restricted your ability to launch in an ETF wrapper. And with 6011 and 18F4, that opened all of that up. And so I think that's part of the reason why we've seen this proliferation of active ETFs over the last 4 or 5 years, and rise in alternative and hedge fund like strategies, derivative heavy strategies. That's been a real kind of impetus and tailwind behind all of that.
Yeah, and if I could just add one thing, having recently done the ETF launch and being new to it, you really want to spend time on figuring out who your right partners are. When we first started looking at this, we were told that it would likely take a minimum of 6 months, maybe 12 months to get to market. We were able to do it in less than 3. And the way we went about that was really by having partners in US Bank taking their recommendations on who we should partner up with and have relationships with, and then figuring out if they were aligned with what we wanted to do. So we found the right market makers, exchanges, so on and so forth, very much by going through that route. And I would recommend definitely taking the time to do the due diligence to make sure you're aligned on that front if you want to get to market quickly.
I'm going to keep letting you talk because you're doing a better sales pitch than I could ever do. But what I'll say on that, all kidding aside, is you just heard that Stone Ridge, which launched 32 ETFs, which is highly unusual to have that large volume of launches, was able to come to market and come to fruition in 3-4 months, whatever it may have been, which is an incredibly expedited time when you think back what even pre-6011, pre-18F4, what it would take to get those products to market could be years. And so what I'll say is in this industry, innovation has always been a way to succeed and gather assets. If you come up with something new that people want, if you build it, they will come, so to speak. And now you can do that in a quick, cost-effective, and innovative way by going through these models and working with partners like the people on this stage. So now I'm going to get into what we'll call a little lightning round, where I'm going to ask questions and I'm going to surprise the panelists on who I'm going to ask so we can see if we can get something entertaining out of this. Hempstead, I kind of wish you were up here. I know you'd get something crazy going. But all right, so the first one I'm going to go with is what is one piece of advice that you would give a new issuer? And maybe we'll look around. Does anyone have any thoughts on which panelist I should ask? Mr. Steve-O, you choose somebody. Connor, go for it.
I think I just kind of gave it. I would say spend a lot of time really, really understanding the workflows of ETFs. They are different. They are nuanced. I think that in many ways, from an investor standpoint, ETFs are easy. They're efficient. They're lower cost, so on and so forth. But as an issuer, there's a lot that goes into it, and you really have to understand all those components. And like I said, really find the right partners to team up with. They will help you get to the finish line and find success.
I think one thing we haven't really touched on is the sales and distribution strategy. I mean, it's very important and imperative to have that buttoned up before you embark on this process. I mean, you kind of alluded to it. I feel like the days of if you build it, they will come are long gone. It is a highly competitive marketplace. There are a lot of ETFs out there. Fees have decreased substantially over time. They don't call it the ETF Terror Dome for nothing. And so you need to think through all of this stuff on the front end. And that means if you have an existing sales team, or you're going to repurpose your existing sales team, or you're going to bring an ETF-specific sales team, how are you going to compensate them? You got to these are all things you have to think through before on the front end.
I mean, absolutely. I think that ETF sales are done in a different format than traditional mutual fund or even private assets. So you need to think through what that looks like for your firm. Take your core competency and try and apply that to your ETF. But you can have the greatest product with the greatest track record out there, and if no one knows about it, you're not going to gather assets. So I think there could be a whole panel on ETF distribution, and but I do think it's incredibly imperative that you have a strategy list of partners that you want to attack and address as part of your sales strategy up front. And don't do that and don't start launching a product until you start to put some thought into who's going to buy it and what's the use case.
Yeah, I think the other thing is just where's that first $25 million coming from? Where's the seed capital coming from to get the fund launched? I mean, it makes it a lot easier to have a product that can help pay for itself so that you can then use all your extra budget for the marketing, sales, and distribution. I think that's really important, but you need to have that captive AUM kind of right away. So think about how you're going to get that seed capital before you go to market.
One challenge I see from a lot of clients with mutual funds launching ETFs for the first time is they're hyper focused on cannibalizing themselves, and they don't want to do that, and they have concerns. And my response to that is always, the innovator's dilemma. Would you rather cannibalize yourself or have someone else cannibalize you? And so, yes, there is potential revenue loss at risk, and you need to review and do that properly. But at the end of the day, barring pending regulatory change, which may or may not be very imminent, if you want to launch an ETF, don't worry about the cannibalization, because right now that's where the assets are going and will continue to grow. And that's why we're all here today. So I would focus on how do you build the best product and how do you launch that in the best manner to gather assets in your ETF, knowing that mutual funds will still be here, but they will continue to have overall drawdowns, and it might even accelerate if share class is approved. More to come, and there's plenty of lawyers who'll give a better opinion than me, but we'll find out more in the next couple months. All right, next question on the lightning round. All right, Peter, choose a candidate, and then I'll ask the question. Steve, oh, lawyer on lawyer crime, I love it. All right, so Steve, how do you see the ETF wrapper and market evolving? Oh, share class, great, here we go.
So, I mean, I think you touched on it earlier. It's anytime you see new and innovative ideas coming to market, it's oftentimes in the ETF wrapper. And so I think that is going to continue to be the case. And that's, whether defined outcome ETFs or, options overlay, derivatives heavy strategies, or single stock ETFs, or, digital asset ETPs. Like, I think, the ETF wrapper has proven to be the wrapper of choice for new ideas and innovation. And that's going to continue to be the case. And I think, we've touched on a number of the regulatory tailwinds that have been behind ETFs over the past couple of years, and I think that's going to share class potential for share class relief is another example of future potential regulatory tailwinds that'll continue on. Awesome.
All right, I'm going to keep asking questions of the audience because that's how we get everyone off their phones. So let me see who I know who's on their phone right now. We're going to go with Fergal. Fergal, why don't you choose a candidate here? And all right, we're going to go with Brett. All right, so Brett, thanks to Fergal's choosing you. What trend do you think advisors and issuers should be paying attention to most?
I think the trend touched on a little bit with Steve. I mean, we keep seeing more derivative products of even the Bitcoin products. So you got the Bitcoin and Ethereum products. So you think about those are ETPs, those are grantor trust, 33 Act funds. But then you think about how a 40 Act fund could use those in their portfolio. Could you use them within a CFC, get exposure to another underlying 33 Act fund? Could you do options on the Bitcoin and Ethereum? So there's kind of more to unwrap there. I think we're going to continue to see different structures that have exposure to digital assets. I think that'll be a trend we continue to see.
Yeah, I mean, starting in August, I mean, the SEC has approved options on a number of these spot Bitcoin ETPs. They haven't gone live yet. It still needs CFTC and OCC sign off, but certainly with the Gensler's days numbered and administration change, I think we're going to see, as Brett notes, I think options are going to be live here in the not too distant future, and that's going to, it's going to be kind of interesting. We've seen, the digital asset ETPs, the spot ones have been all in the 33 Act only realm. They're not 40 Act registered investment companies, but it's going to be a way that things kind of come back to the 40 Act world with these option strategies.
All right, this is my fun little game. We're going to go with DeSalvo. Okay. What is the greatest threat to the ETF market today? Paul, can you choose somebody on the audience to answer, or on the stage? All right, back to Steve. No, everyone loves picking on lawyers. Go ahead.
So I got to be honest. I mean, there's nothing that I lose. Look, I think there's a lot of good momentum. Can't ignore the flows. A lot of good things going on with ETFs. Nothing that I'm losing sleep over. So I don't know. I mean, there's nothing that keeps me up at night, I think.
I think people are going to have to figure out all the asset gathering and what to do with all of that. I think that's the big threat, right? Maybe not. All
Maybe
right.
direct indexing. I've heard that's a threat into the ETF space, but I think that's still fairly nuanced, and I still think the ETF wrappers for most investors, and I think the RIA community has really adopted ETFs. I think that's going to continue to be the product of choice.
I mean, if I had to come up with something, like maybe, I mean, a couple years ago, people got a little hot and bothered when there was some, discussions of draft legislation circulated by Senator Wyden about the tax efficiency angle. So if something ever kind of happened on that front, from a negative standpoint, I mean, that would be a big deal for the ETF industry.
Well, we got one last question before we conclude the panel, and I'm going to ask it to all of you. So we'll start with you, Brett. But what is your biggest prediction for the ETF market?
I think we will see share class at some point. I think that'll be maybe end of 2025.
I agree with that. I'm pretty optimistic on that front, and particularly with the administration change, I think that ratchets up the likelihood of that getting approved in the not too distant future.
Yeah, I don't know that it's that big of a surprise, but I do think that active ETFs will take up a much larger chunk of the ETF market as a whole over the coming years, and I'm very interested to see how that plays out.
So I'll just conclude by saying I agree completely that share class is definitely on the horizon, and also that active ETFs will continue to grow share of mind with investors and also with assets. But I'll put a little wrinkle on the share class prediction. I think when the share class, if it potentially gets approved, it's actually going to accelerate flows into ETFs. And I think that that's going to be dramatic. And I think you'll see a bigger shift in the industry than I think many are predicting. That's just one man's opinion, but I'm here to share it on a stage, and they gave me a microphone. So with that, I want to thank my panelists. I think this was a great panel, and appreciate your partnership in coming up here. And I'll hand the mic off to Mr. Steve-O.
Thank you very much. Actually, before you go, are there any questions from the audience? Or did Josh get to all the questions before we could ask them?
I planted them. I don't know that I mentioned this, but U.S. Bank has a multiple series trust. We've got 10 of them, actually. So pick your poison. Any others?
I did have a question just around that topic of the in-kind tax exemption. I mean, what is the likelihood of of that, like, let's say, getting rescinded? Ultimately, it is a concern, but at the same time as well, what are the obstacles? Let's say, to actually to get that pulled. I mean, just how likely is it? And then ultimately, if it happens to be, any thoughts on like what the impact to ETF investors might be to the ecosystem?
So, I mean, the tax efficiency is such a key feature of the ETF wrapper, and I mean, the way I think about it is who's going to bear the brunt of this? It's going to be all the investors out there that own ETFs, and so my personal viewpoint is that we're U.S. government running bigger and bigger deficits, and occasionally from time to time they are evaluating things where they can find money to pay for things. But I just feel like, the ETF industry is so big, and this would be a huge disruption to that industry that I just don't think it would be palatable.
I'll just say, I mean, and no one can predict what happens in the future with politics, but when you eliminate that tax exemption or the tax treatment of ETFs today, you're in essence doing a tax hike. And you're increasing taxes on people who are looking to utilize those assets to retire. So I don't know how popular that would be across either party to increase taxes at the detriment of retirees. So I think that there's definitely some challenges to that. But I'm not in the prediction game about what happens in the future, and I cannot predict political environment, so you never know. But typically raising taxes on people trying to retire and live off those assets is not a popular opinion.
Okay, thank you. Any other last questions? Okay, well, appreciate everything, guys. Always awesome to hear these updates. So, as always. So, give them a round of applause, please.